Okay, let's go through some of the questions from Sunday's Q&A. I haven't read most of these, so as I'm going through, it'll be the first time I'm reading a few of them. Let's see, first one. I have been born into a very fortunate situation in inheriting my father's family office in managing plus or minus 300 clients. Although I'm still in college, I feel that I want to prepare myself even more to manage people's money in the best manner possible. Well, that's good. You're leaning into it. I have purchased the Applied series on your website and plan on doing the same for CFAs level 1 through 3 once I graduate college next year. Is there anything, in your opinion, that I should focus on in order to prepare myself to manage clients' money in the best and, more importantly, time-efficient way? I could definitely tell myself that becoming the best financial analyst that I can will help my clients and hopefully their returns. However, I do not think it's feasible to be an all-round analyst in all sectors and to focus on trying to grow my client base further at the same time. Well, so I'm not even sure what it is you do for your clients here. Whether I doubt strongly you manage 300 portfolios. I think you have 300 clients. I think you probably set asset allocations, and then use external managers for the equity portion, for the fixed income portion, whether it be domestic equities or international equities. You probably have a number of managers that you use, and perhaps you have some methodology for setting the asset allocation depending on age and client characteristics. And you may even get your capital market expectations externally. I really don't know. But I would seem to think for the position you have that relationship management probably is the key characteristic you need, especially if you have to build your client base. And probably being a more top-down analyst is probably going to be more beneficial for you than bottom-up. That I don't know that you have to be a great bond picker or stock picker, but rather have a view of now's the time to be in equities, now's the time to be in bonds, now's the time to lean into duration, now's the time to pull it into the cash market. I think that probably would matter more for you. But without a lot more information on exactly what you do for clients, that's about all I can offer. It strikes me that an economic system that has a single, very blunt approach, raising rates and waiting, well, let's distinguish between an economic system and monetary policy. An economic system has many tools. However, all those levers are usually pulled by fiscal policy, not monetary policy. Monetary policy has a very blunt tool when it's looking at conducting its policy towards price stability, which is the interest rate, which in the end really is a theoretical approach. It is based on equilibrium economics. We believe that there is an effect that the interest rate has on consumer demand, and that there is some effect it has on the level of savings versus the level of consumption when you raise the short-term rate, the one-period rate. That's all theoretical. Once you bring free choice into it, and you have a consumer or a mass of consumers that will spend everything they make, they'll just spend it in different places, the interest rate may not be that effective. Raising and waiting of dealing with the perceived biggest potential issue in that system, inflation, feels like a very poorly designed system. Well, come up with an alternative. There is no other alternative that when faced with inflation has the flexibility of capitalism. Socialism can't. Socialism simply just suffers. There's nothing socialism can do. Communism, forget it. Again, you suffer. So there is no better system for allocating capital than capitalism. There is no better system for incentives and putting incentives in place than capitalism. All other systems primarily are filled with disincentives. Socialism is one big giant disincentive. So I don't know that there is a better system. Is this really the best system we can come up with? Yes. Yes, it truly is. Or is there a better one? We're just stuck with what we have. There is a better one. It is called electing people to government based on their policy stance and their qualifications and not party affiliation. I mean, if you've listened to the congressional and the Senate testimonies over the last 2 days, and you listen to some of the questions these politicians asked, and some of the statements they made, and the grandstanding they made, and the blatantly false statements that some of them made, they basically abdicated all responsibility for managing the economy, all responsibility, and put it all on the central bank. These are your elected officials. The reason there is so much emphasis on central banks is because governments just don't do the job anymore. They just don't do the job. They haven't for a long time, but it's even worse now. It's clownish. So you cannot even count on your elected officials to do the right thing, because here's the deal. About 80 to 90% of them have no fundamental understanding of how the economy works. None whatsoever. None. And that's it. So it's not that the economic system sucks. It's that the political system sucks. Capitalism is very much the probably best system for allocating resources in an economy. But democracy today, democracy is broken, is very, very broken. I don't know what replaces it, but until citizens stand up and say, okay, that's enough of this dog and pony show. This is what you're going to get, dog and pony shows. What gets voted on gets displayed. And if the voters are basically well ensconced in their camps, I'm Team Red, I'm Team Blue, then Team Red and Team Blue can do anything they want, and they won't lose their voters. They don't have to actually do their job anymore. But yeah, if we want to know why there's so much emphasis on the central bank, is because what? The government, right? I'm doing a similar strategy to Tesla. I'm trying to get Amazon for free. On Amazon, where I own the stock and have a short put and call on it, and been rolling at 120 and 80 delta range, and so far recovered 3 since last week. I've watched your applied series on rolling today, which is super helpful. You mentioned that we should have a target of 50 delta or so and not let the short call delta get too high. Well, that's if you when I say that you should have a target, if you sell a call, just a call, let's say a 30 delta call on an underlying, and the underlying starts going up, you got to have some point where you say, okay, I got to step in here before you let it get too far out of control where the delta on the call is 0.8 or 0.9. At that point, it becomes very difficult to manage. You usually stay out of or get out of trouble by staying out of trouble, so you'd want to step in early. That was the point of that. Or so, not let the short call delta get too high. In this case, I have been doing this strategy since last week and rebalancing the combined delta back to 100, and Amazon keeps getting higher, and I was unable to roll down the call to book the profit once, but most profits came rolling up to the puts. I'm not following that, but okay. My question is, now short call has a delta of 0.8. You have the underlying, the call has a delta of 0.8. Because I own the underlying, do we approach the risk management differently and not really worry about the deltas getting too high? Yeah, at that point, don't worry about the delta on the call. It's a delta on the position. If you have 0.8 on the calls, you have 1 on the underlying, you basically have 20 deltas per 100 shares. So, as it goes higher, you're not really gaining anymore because the negative convexity of the call is taking it away. At that point, you just hang out and wait. If it gets called away, it gets called away. You can get more aggressive on selling puts. You can sell a 50 delta put at that point because you don't mind the shares being put back to you. Let's see. I appreciate your time and effort going into these videos. I have 2 questions. When managing my portfolio on IB, which risk parameter should I use on portfolio risk tab to assess the total bullishness or bearishness compared to the S&P 500 index of my portfolio? Is it weighted beta, delta dollars, or beta delta dollars, or a combination of all three? I use beta delta dollars because I just have so many options. I really don't hold a lot of shares. The ones that I do hold are because they have a dividend associated with them, and I can use the options to generate even more income on them. But because I have so many options, I have to use some measure to capture that. So the beta delta dollars make sense for me because it just gives me one number that includes everything, rather than saying, well, what if this is a $10 stock and what if that's a $100 stock? Shouldn't I, since beta is a sensitivity, shouldn't I know how sensitive my portfolio is in dollar terms? So I use beta delta dollars. But keep in mind, that's not going to, if you have, let's see, currency futures, if you have bond futures, if you get into some of the commodity futures, beta delta dollars isn't going to do anything to help you there. But most of those should be uncorrelated with the equity position anyways, but you're not going to get an idea of the risk, of the entire risk associated with your portfolio because of that. The beta delta dollars is really capturing those things that have some beta associated with it. So for example, TLT has some beta, very, very low beta, but it's there, and beta delta dollars captures it, but it's not much. It's just not that much. So while it does have some incremental effect on the portfolio because it has some beta, it's so very, very small as to be meaningless. However, ZB, which is the treasury, the bond treasury futures, is not captured by dollar delta beta because it has beta of 0. So TLT does have some beta, but which is made up of bonds, and the underlying of ZB is bonds but has no beta. So it's one of those things of, well, maybe there is some correlation with the market in that there is some beta. I guess you wouldn't call it beta, but some correlation that's not being picked up. All of these things, by the way, when we talk about beta, when you talk about duration, when you talk about any kind of sensitivity, because these are sensitivities, right? That's all they are. Is duration is how sensitive something is to a change in interest rates. Beta is how sensitive something is to a change in market rates. These are all theoretical. They're not rules. They're not hard and fast rules. They're all just theoretical. So you can have a stock that has a certain beta based on how it behaved in the past. That does not mean it's going to behave that way in the future. So all of those portfolio statistics gives you the best, the best it can based on what history, based on how it performed in the past. And it says, based on how it performed in the past, if you expect the future to be the same, this is the sensitivity that your portfolio has right now. Doesn't always work that way. Sometimes it does, and other times it's like, nope, does something completely different. So they're all just theoretical, and from day to day, it just happens to be the best that you have. So I wouldn't look for absolute precision on that. At this juncture of the rate hiking cycle, where we may be closer to the end than the beginning, is there some merit in having a barbell bond portfolio? By barbell, I think you mean some in cash, some in long duration. Yeah, I think so. If rates rise, then the short maturity bonds can be invested at higher rates, exactly, somewhat offsetting the loss in the longer duration bonds. While the unrealized loss, you don't have a loss unless you actually sell, right? And if rates fall, we have reinvestment risk with shorter maturity bonds, but long duration bonds would benefit. Yep. That's that makes sense. Could you explain in detail how the Federal Reserve repo reverse reports and market indicators we can derive from it? Well, explain in detail, not really, but I'm not going to explain it in detail. I don't know that there's an answer that will satisfy you, that you couldn't Google yourself and understand what the repo is doing, but to explain it in detail and what indications you can derive from it, I don't know that there's really much unless you really want to get deep into the plumbing of the banking system. So I'm going to pass on that one because I don't know that it's asking a specific question. It seems to be asking one of these gunshot questions of, if I hold a half-hour seminar on this topic, you might get the answer you want, but I don't know what answer you're looking for here. Trying to wrap my head around your comparison between the yield on IG bonds and the earnings yield on SPY. In my mind, it's not fully comparable. Well, I gave the explanation of why I use it, of why you can use it. The yield, no, it's not fully comparable. The answer or the pushback I get on this one is exactly the answer. Is, yeah, but while you'll only get the yield on the IG bonds, the index could go higher. Yeah, and it could go lower. That's the very point. That's the very point right there. The yield is, when you calculate the yield, is just the inverse of the PE. Take the inverse of the yield and you have a multiple. So it's just a matter of how many times of earnings do you want to pay for the underlying. We look at a PE and we're perfectly fine looking at an index saying, okay, well, it's 18.5 times PE. Well, that's just the inverse of an earnings yield, right? So if you have a PE and you take 1 over the PE, you get an earnings yield. But a PE is just 1 over an earnings yield. And you feel comfortable using a PE, and that's really just 1 over an earnings yield. So it's the same thing. You could take the IG bond and 1 over the earnings yield, and you'll get a multiple on the high yield bond, and you can compare it based on multiples. Typically for the longest time, for quite some time, I don't know going back how far, but if you look at the, you can look at a 10-year, for example. You look at the multiple on the 10-year, which is 1 over the earnings yield, and you can compare it with the multiple on the market. You should be paying a much higher multiple on the 10-year, because there are 3 rules of money. Number 1 is larger cash flows are worth more. Number 2, sooner cash flows are worth more. And number 3, safer cash flows are worth more. So you should be willing to pay a higher multiple for safer cash flows. So if you took, let's say, a 10-year yield at 3% and you did an inverse, you did a multiple, you'd get 33.3. So you could say, well, that you can easily pay a 20 times earnings on equity because the 10-year is 33.3. It justifies a higher multiple. But when you have the multiple on equities being higher than the multiple on safer money, there's a bit of a problem there. So if you're comfortable with a PE ratio, you got to be comfortable with an earnings yield, because it's really just 1 over the earnings yield, right? Is it possible that the Fed doesn't cut rates even if there is a recession? Yeah, it depends on the type of recession that you have. But it is more unlikely that they wouldn't cut rates. The political pressure would be off the charts. And I know they're independent, but you still have political pressure. If there is a recession, usually the fastest cure for inflation is a recession. And if there is a recession, it would be curious if inflation remained high. That would be a problem to solve. That would then be one of those head scratchers that you look at and say, well, what could it be then? How is it possible that we could still have this price pressure even in the face, clearly in the face of rising unemployment and dropping demand? How could it be? And the only solution, or the only answer, would be is that businesses and the suppliers of products and services have somehow tacitly colluded to restrict supply, to always restrict supply. We know that there are some companies that will manage their supply now so that they don't go back to those pre-pandemic periods where they had to compete by, with their output based on, in well-supplied markets based on giving incentives and discount prices. That'd be the only thing in a well operated free market system. You could get periods of high inflation with rising unemployment and a recession when you do not have a freely functioning capitalist system. For example, you have a lot of regulation in place about where money can go and where money can transfer and how much money can be paid. Then you could have inefficiencies that stay in the system. What John Nash called a suboptimal equilibrium is that the economy could get stuck in one of these suboptimal equilibriums. If that were the case, you would have to find the regulation that's stopping the free flow of capital, that's stopping the adjustment process from happening. So let's say, for example, that we passed a law that said profitable companies cannot lay off workers. So let's take company ABC. And let's say that the regulation is such that if the company is generating profits greater than $1 billion, that it cannot lay off workers. For most of your very, very large companies, it would eliminate them from laying off workers and releasing workers back into the workforce. Well, that would keep wages high. And they couldn't adjust simply because you had these labor policies that were so pro-labor that they were anti-capital. And if you have something like that in your system, then the adjustment process would not happen. You would have an impediment to the adjustment, and that's what's called an unintended consequence. That you had some good intentions in mind saying, well, let's protect workers even more. And let's make sure that if a company is profitable, it can't lay off its workers. And if you did that, then you wouldn't have that readjustment, and you'd constantly have wage inflation and inflation. In a system like that, you would have to raise your inflation target or completely break the economy. Completely break it to get it out of there. So usually, at least what we have in North America is free enough. It's absent enough regulation that it can adjust rather quickly. Can TLT still perform if the Fed doesn't cut rates this year, but things are looking highly recessionary by the end of the year? If they're looking highly recessionary, then they'd look highly disinflationary at the same time. I'm a German student. What would you recommend me to do and to learn to become a good asset manager? I would recommend the CFA program. I try to think about some other aggregation of knowledge that has the progression that it has, and I think it does a very good job. Yeah, there are some parts of the curriculum that I think, well, maybe you don't need this and maybe you don't need that. And if you say, well, I want to be really good at one particular thing, it's like, well, maybe there's some things at level 3, like, private wealth management that you may not need. But it does, give you a good general education at all 3 levels. And then, you determine which of the asset groups you want to dive deeper into, or which focus you want to have, bottom up, top down. But I would recommend that progression. For the minor's thesis, would you consider XME or PIC? Probably PIC. I have sold some puts on XME this week on Tuesday. When the market really went down, I sold some puts on XME. PIC didn't drop enough for me to sell any puts on, so I think I got puts on Rio and FCX. Didn't get any on PIC or BHP. They just didn't come to the point where I wanted them. First says higher allocation to aluminum, gold, and silver, and only U.S. companies. That is true. Second focus more on iron ore and copper and has global firms. That is true. PIC will have the higher implied volatility, I think, over XME. PIC is I think, probably a better one over XME, but it just didn't come into the to where I wanted it to be. But I would sell puts on both of them. But if I had to pick one, drop dead pick one, it would be PIC. In this week in earnings, we see the earnings forecast per quarter. As per March 3rd, the earnings forecasts are respectively those. Obviously, the longer out you go in time, the more uncertainty there is regarding making earnings forecast. Yep. Do you know why the inflection point to earnings from negative to positive in Q3 and especially a 10% increase in Q4? These margins take into account to arrive at the forward EPS of 2021. If you ask an analyst or any top down or even bottom aggregate, a whole bunch of bottom up estimates, if you ask any analyst and any company analyst to forecast earnings, always looks like that. Always. They are recession agnostic. They are almost growth economic growth agnostic. Is they'll forecast out a growth rate and that's it. Sometimes they'll have a 2-period model where they'll forecast out a growth rate and then they'll do that, and that's really just about it. And everything under EBIT is not forecasted at all. Any non-operating stuff just is forecasted with a 0. I've yet to see a forecast that does this and this kind of thing, and then this, and then saying, well, that's the recession. Oh, that's interesting. I've never seen that in a set of earnings. So usually, if there is, any kind of negative economic impact, it would be in the near term, and then it goes away, and then everything is bright and rosy, and off you go. So that's just normal to see that. I don't know that there's anything in there other than just, well, things look a little tough right now, but they're going to cut rates, they're going to pivot, and everything's going to be okay, and by the fourth quarter, we'll be back to 10% growth. It's just, it is difficult to forecast the recession because usually, you can't really forecast that kind of thing because it's one of these things that just sort of shows up. So let's think about. I don't even know if I have a good picture for it, but I'll just draw it out like this, and we'll just draw a straight line, and we'll put over here, conditions. And the conditions here are right for a recession. In other words, you have high rates, you have low investment spending, you have higher or less willingness for, I guess just CapEx in general. Something like that, you get a condition like that where you get an external shock. If the conditions are right, it can send the economy into a recession. Whereas here, if you have low rates and you have a high level of CapEx, even if you get an external shock, the economy can absorb that shock. But when the conditions are right, you get an external shock, it can't absorb that shock. That's usually we don't usually say a recession will happen in Q3. You can say we have the conditions under which a recession is completely probable. If you get an external event of this type, some credit event that has some kind of spillover effect, or some kind of key resource, or some kind of key input. So let's say that something happens in, Israel does a strike on Iran because of they think, they're going to get a nuclear weapon anytime, and they do a massive strike on Iran and the whole region erupts. Well, that's That's a huge problem right there. That is enough of an external event to push the global economy into a recession, because energy would the supply of energy would shut off very quickly from that entire region. So it's something like that. So it's not it's hard to predict when something like that will happen, but it's easy to predict that if something happened, the economy would go into a recession because the conditions are there for such a thing to happen. A long answer to your question. Did I get everything here? Do you know why the inflection point in earnings? No. These margins are taking into account to arrive at the forward EPS 21. How do Q3, Q4 forecasts increases integrate into the margin compression story that you're expecting? Well, these are just forecasts. It's, I mean, that's all they are, is just some people saying, I think this will happen, I think that'll happen. And here's the thing, the future is unknowable to anybody. It's just somebody's best, and I'll write it down, guess. It's somebody's best guess as to what they think will happen, and that's all it is just a guess. That's it. That's all. So when when one of the Fed presidents come out and says, I see a soft landing with unemployment going no higher than 4.1, it's like, yeah, well, and somebody else sees something different, but you do not know at all. You have no better view on the future than an analyst in an investment bank, because you have access to the same data. In fact, I'd say the investment in the analyst bank probably has access to better data because they're more connected to the market. So you don't really know at all. All of this stuff, they're just forecasts. So what you're seeing here, this 3.2 and 10.6, nobody knows. Nobody knows. Let's see. Q1, Q2 seem to expect some contraction, but then a full recovery in Q3, Q4 could seem too optimistic, and hence a 221 forward EPS as well. Yeah. That's the best you can do, is either agree or disagree with what you think the future is going to be, and you have to put money at risk based on what you think. Last week you mentioned ZB is the equivalent to TLT, which is commonly said, but when I Google duration of TLT, various sites state around 17, which is about right. If you look at the Treasury Analytics tool, it shows actually UB is closer to TLT in duration at 16.6. Yeah, UB will be somewhere around 16 on duration instead of 13 for ZB. 13 would even be high for ZB, around 12, 13, I guess. So is choosing UB a better choice than ZB for a TLT analog? Yeah, well, it depends on I don't know that you have to get the right duration when you're looking at a whole bunch of different things. So you're looking at a bunch of bonds that all have different duration, and you're saying, well, which one should I get? The duration alone isn't telling the whole story. You have to look at something called dollar duration. You multiply the two together to get a dollar duration. And if you look at ZB, it's about 12.5, it could be anywhere from 11 to 13, and UB is usually 16 plus. And your margin for UB is about 50% more than your margin for ZB. So you need 50% more capital to get that done, but you'll get about 50% more duration in getting that done as well. So I can still get to the 16, instead of using 2 UBs, I can use 3 ZB, and I'll have the same dollar duration as 2 UBs. So the duration alone isn't as important as the dollar duration, because the amount of capital that you got to put up to get this futures contract done, right? UB is, I think, somewhere around 135 per contract. ZB for June, that is, ZB is around 120, 124, 125. So 3 times this duration, dollar duration, and multiply the dollars by the duration equals 2 times this dollar duration, you get the same thing. So it's not important to get the duration right as it is, trying to target a certain dollar duration. You do have to look at the capital that you have to put up. As far as liquidity, though, UB is just as liquid as ZB. ZB has higher volume than UB, but UB has enough volume that you can't say, well, it's not liquid. It does like 200,000 contracts a day in the futures market. I have a question on Fed's action. Why not raise 300 basis points? Just like what you said in last week's video. If you're trying to alter the economy's consumption behavior, wouldn't slow increases be easier to ignore? Why not just raise the water to boil so the frog jumps out? Well, I don't know if I said raise 300 basis points, but, there are some members of the committee that think, if we need to raise rates, why not just raise them all now and get it over with? 300 would be punishment. Would be you would hurt a lot of people, and that in itself could cause a lot of systemic risk because there's a lot of contracts, a lot of derivative contracts tied to the interest rate. That if you went 300 basis points, the transfer of wealth, it doesn't create wealth or destroy wealth, but there's massive wealth transfer. These are used to hedge out a lot of things. The amount of liquidity that would be required might even break some institutions and some funds where they can't meet their counterparty requirement for payment because the move was just too big. You would break things if you move 300 basis points. A central bank really only does that if it wants to punish somebody, and usually if they want to punish currency speculators. Bank of Canada did this in the 90s, where without warning, overnight, they raised interest rates 100 basis points just to punish currency speculators that were selling the Canadian, because the Canadian was down like 60 cents on the dollar. And they did it just to punish them. And then the very next day, they brought it right back down again. They just did a one-day thing just to hand out a bunch of losses to these speculators in the currency market. A good bloody nose and sort of a warning of don't do it again because you never know when we're going to do this. And that's, usually something like that is meant to punish. To my understanding from your last Q&A, the G spread is the spread of corporate bonds over a government yield, over the same maturity government yield to account for risk. But isn't it also a case for G spread OAS? No, it is not. The G spread is a yield spread, not a rate spread. So there's your par curve, let's say, and there's your corporate bond, and you can find some government bonds, and you can interpolate what if the government bond existed that was, let's say, 6 years, 6 and 9, 12. So you can't find a treasury that you find some that are very close, and you interpolate what it would be, and you just look at the yield to maturity, and you look at the difference between the yield to maturity. Well, the yield to maturity is a weighting of all of the different rates. So here's your yield curve, and you have a coupon at all these different points in time. And then you have your bullet payment and your principal here. Well, there are different spot rates that are used to discount each cash flow. Particular spot rates, zero coupon bond rates to discount each cash flow. And then you come up with a price, and then from this price you can calculate what the internal rate of return is, or what's called the cash flow yield of the bond, which equals its yield to maturity. A Z spread has, for each spot rate, would have a constant spread on each spot rate. So the spread is the amount added to each individual spot rate, whereas a G spread is just the difference in the yield to maturities. It's not the same thing. And the OAS is kind of like the same thing with the Z spread, but instead of added on to spot rates, would be added on to forward rates. If you're trying to price out a bond that has an option, a bond that has no option, the Z spread equals the OAS. So it's not the same. And this, by the way, you will get in level 1 fixed income. You will see a lot of it in level 2 fixed income, and then you should, by level 3 fixed income, better know this. because there's a whole reading on credit, managing credit portfolios that, well, if you don't understand the spreads, you're not going to understand how to trade those spreads, right? Just appeared for level 1 through your video lectures for starting the prep for level 2. Would you suggest which topics I should review? Feels like I'm already starting to forget the concepts. Just jump right into level 2 and review opportunistically. I wouldn't spend a lot of time reviewing level 1. You will remember it as you start going through a particular reading. You might say, I've forgotten this, I've forgotten that. Then review that opportunistically, when you need it, as opposed to review a bunch of things that you may or may not need. I am confused with the explanation for repurchase agreements in the agency video. You mentioned the investor borrowing the securities will also receive interest and principal on MBS. No. In a repo? No. No, not in a repo. If you're actually borrowing securities, yeah, but not in a repo. There's no transfer. I'm going to pass on that because this is something that you can ask in the Q&A for that. You should note on the site now for the applied series the schedule for office hours. I believe that's done and up. So if you have the applied series, once a month I'm going to be holding live sessions on the site where you can ask any question you want related to the content of the applied series, so that it doesn't questions don't spill over here. I was looking at FCX, but I already got lost in the first 5 pages of the 10K due to all the technicalities reported there, such as different copper products, mines, etc. How do you approach a deep dive? How to keep all the information straight in your head. Yeah, FCX is big on copper, gold, and I think molybdenum. Molybdenum is a sort of an output of the process of copper mining. Don't go to their 10Ks first. Go to, for any company that you're interested in, the 10K is hardcore. Well, when I say hardcore, it's when you're going to the 10K, you already know what you're looking for. You know, if you're trying to learn about the company, it's a tough learn because it takes no time within it to help you understand the company. It is really for the sophisticated investor. Go to any site, go to investor relations. Okay, go there right away and look for investor presentations. And every quarter they have a PowerPoint presentation. So much better to understand the business. If you're really trying to understand the business, that's where you want to start. It'll give you some very high-level information that's important to you, and from there you can then go to the 10K and dive a little bit deeper, and you'll have a better understanding of what you're seeing in the 10K. But to head right to the 10K, especially for a company of which you may not understand the economics of the business, like mining, you'd want to go to the presentation. There you get a very good idea of sort of what you're looking for in terms of FCX. So for FCX, you'll find out very quickly that it's the price of copper that's going to be critical. It's the US dollar also that is going to be critical, and it is their forecast for volume. So what they forecast for volume for copper, what the forecast for price of copper is going to be, and what the US. And it's difficult to do a forecast for the price of copper, so what they do is they give you an EBITDA sensitivity. Plus or minus 0.10 per pound of copper, I think for FCX is 450 million. No, sorry, 250 million. 250 million. So if the price of copper throughout the year goes up 40 cents and stays elevated, that's an extra $1 billion in terms of EBITDA for FCX. So when you see the price of copper move like this and you see the price of FCX move like this, you understand why. Also, it's tied to the US dollar. The lower the US dollar, the higher the price of copper, right? So volume, price, and the US dollar. You want to try, in every business that you're looking at, you want to try to bring it down to a few key drivers that you can pay attention to, and then trust that management knows how to run the business, right? So what does management really want to see? Higher prices for copper, right? The ability to produce higher volumes of copper at the same time, and a weaker US dollar wouldn't be too bad. And then just trust that management knows how to run that business. If you give it the three things that it's asking for, good. That's really what you're trying to get out of it. You're not there to second guess management or to figure out how to run the business better or understand how they run their day-to-day operations and all of the decisions that they make. You want to bring it down to a few big things. That's what these investor relation presentations will do. Start there. Let's see. Okay. You have mentioned that you were overall short beta and long duration. Yep. If you were to hedge that main thesis in case it ended up being wrong, but I am hedged already. Short beta, long duration is a hedge already. Hedge my hedge. In case it ended up being wrong. Well, to be wrong, I would have to lose on both sides. So the market would have to go up and bond yields would have to continue to go up. I just can't see that happening. Yields going higher and higher and higher and the market saying, give me more, give me more. For any period of time, I can't see that happening. If bond yields started to drop, my duration would pay off. And if the market went up, my beta would lose. There's my hedge. But to have them work against me, I'd have to be in a situation where bond yields keep rising, and somehow that does not slow the economy down, and the economy feels like it could accelerate into that. I don't have the math to get that done. So I don't think that I'm at too much risk here. What do you think would be the cheapest and most positively convex expression of that hedge? Close it. Because I am hedged already. So I have recently graduated university, came across your page and looking at the CFA program, interested in purchasing your applied series. Curious if you advise the applied series before CFA. I advise the applied series with CFA. So if you go to markmeldrum.com, what I have done now is I've added a level 1, 2, and 3, a plus package. So you have level 1, and then the level 1 plus includes the applied series. Now here's the nice thing, is the applied series lasts all through. So you don't have to do it again. You buy a level 1 plus, then you don't have to buy a level 2 plus. You just buy your level 2, your level 3. So you only have to buy the plus once, and then you get the applied series. I advise it throughout the whole process because there are some things in the applied series that at level 1 you'll recognize. At level 2 you'll recognize even more, and at level 3 you'll recognize even more. So that when you get to topics that are abstract to you, they may be very concrete in the real world, but to you they're very abstract. You're reading it and you think, I don't know what you're talking about. You're saying it's this and it's that. I guess I'll take your word for it because you've never heard of it before and you've never used it or did anything with it. Well, when you see it in the applied series, when you actually see it applied, then you start saying, oh, that's how it works. Okay. Then suddenly the description, which is written by somebody who may not have the best conceptual understanding of what they're talking about, then the description starts to make sense because you say, okay, now I know what you're referring to when you say that part or this part. So I do think for the progression through the 3 levels, the applied series is absolutely critical. The other thing that I think is absolutely critical, once you start your level 1, you should be opening up a paper portfolio. You should be opening up a paper portfolio. Interactive Brokers will allow you to do this, and you should be maintaining a portfolio through your 3 levels. And every month you'll look at your percentage. Next month you'll look at your percentage and calculate, not just your percentage. You got to look at the volatility that you're taking on. Calculate your Sharpe ratios, and through the 3 levels you should get better and better and better. What a better what better thing can you have to walk into a job interview and say, I've got my level 2 behind me, I maintained my paper portfolio with Interactive Brokers, here it's broken down by Q1, Q2, Q3, Q4 of last year, and I have Q1 and Q2 of this year, here's my return, here's my level of risk, here's my Sharpe ratio, look at the progression of my Sharpe ratio over those quarters. Anybody interviewing you will look at that and go, whoa, all right. They don't have to worry about where your mind is or what your motivation is. And because you have the Applied series, if you're watching the Market Outlook every Sunday, you should be able to have a good, deep, intelligent conversation with them about where the market is. And if you say, well, that's a lot to do. Yeah, but that's what a career is. Okay, so you have to decide right now, are you in or are you out? You cannot be in the market part-time. You can't. It just doesn't work that way. If you're in, period. But you can't just dabble in it. If you're going to dabble in it, then use an external manager who's in the game and pick another field. But to answer your question, I think you should do it concurrently. I think you should have the paper portfolio concurrently as well as you go through levels 1, 2, 3. I'm going to be putting out more videos about this particularly in the weeks coming up, because we just got the level 1 plus, the level 2 plus, and level 3 plus packages listed, and now it's a matter of explaining why I think it's a good idea. Let's see, for quite some while, it seems that bad economic data is positive for stocks. When do you think it will change? The bad economic data is also bad for stocks. I think when the data is clear that the bad economic data is going to be negative for earnings and not positive for rate decreases. So negative economic data suggests there's an end to the rate increases, and right now that's the only story in everybody's mind is when's the central bank going to stop? Because when they stop, that's our green light, we can go. And they're not really worrying too much that bad economic data is actually bad for earnings. That's not in there yet. Once you get the interest rate story out of the way, then they can start assessing the economic data for what it means for earnings and not what it means for the discount rate. Buying SPY with high multiples and deteriorate earnings while bills are yielding 5% plus is insanity to me, and it's the opposite of being compensated for risk. I agree. I was net short most of 2022, and I'm tempted to start opening small positions back up. Lately, I've read a few things regarding the Fed's inability to keep rates raised for long due to the debt situation. Interest payments will take up larger and larger portions of the budget, and a debt spiral will eventually happen, particularly if tax receipts drop, forcing Congress to take on debt to pay the interest from cumulative debt, creating a feedback loop. Listen, you don't have to worry about Congress taking on debt to pay the interest. They'll just take on debt. Don't worry about that. They're going to keep on going. There is a day of reckoning coming for not just the U.S. but for most advanced economies who think that they can continually do this and keep rates low just to support their massive amount of debt. And I think we're going to see that with Japan. Is either they're going to have to raise rates or they're going to face the very real prospect of capital flight. Individuals in that particular country are going to go elsewhere for their return. And that's going to create a bit of a problem where the central bank will have to continually buy more and more and more and more government debt just to keep it alive. At some point, there's going to be a reckoning. At some point, there has to. So Japan's going to be interesting to watch. But I think that if there's going to be a problem, wouldn't it be better to find out now while there is something that can be done about it than to wait until you have 250% debt to GDP and there really is almost no pleasant way out of that at all. Japan's got a particular problem is given that they have a shrinking population, their debt truly now is unsustainable. And once you start down that path, what you can do is open up your borders to massive immigration and raise your GDP. Then your debt to GDP looks manageable only because you've boosted GDP so high and you've increased the tax base. But countries that are unwilling to do that, for whatever reason, Japan is probably, of all the advanced countries, the least willing to embrace immigration. That's not going to end well, because you're going to have a shrinking GDP and a shrinking tax base as your population shrinks. You got to deal with that. So let's deal with it now. No more kicking the can down the road. Every time there's been this debt crisis, we just simply kick the can down the road. Well, maybe let's make this the end of the road and let's just deal with it. Get it out of the way, right? Let's see. In my view, the Fed would never willingly let this happen based on its actions for the past year. Do you see a situation where the Fed would have no choice in the matter? Well, if you can look at the Bank of Canada and the decision it made today. It took into consideration the level of household debt in Canada, saying, look, this is already hurting a lot of people, because Canada has a different housing market than the U.S. when it comes to the amount of the type of mortgages that are held. So it is going to take its toll. So the Bank of Canada has recognized that and said, because of the sheer amount of debt and debt considerations, we're going to hold right here. And it did note that inflation is elevated. It is too high, but we're going to let it come down. We're going to hold at this point. I think one of the first central banks to stop raising rates and hold, but they did signal that. We'll see if it works out for them. It could be, if inflation keeps coming down, it could be a template for other central banks to say, well, maybe we should hold too and go on faith that it'll come down. But yeah, the Canadian central bank did that. So I built a model that arranges key rates automatically. Okay. Do you have a video on why you're structurally positive on home builders and miners? Because there are structural deficits. If you download Freeport's their Q4 2022 presentation, they have a whole slide of why they're structurally bullish on copper. And every bullet point on that slide, that would be my answer. If you do the same thing with DHI or with Lennar, the two biggest home builders, in their presentation, they talk about the state of the market and the shortage of homes in the market. So those are the same reasons that I'm bullish on them as well. Isn't the earnings yield on SPY more like a real yield? I've answered that already, and I think 2 or 3 other times in previous videos. Regarding 0-day tabulation options, I'm guessing only retail speculators will be buying these options. However, I've heard they represent half the volume on options. JP Morgan says less than 20%. That it really isn't the retail crowd, which makes sense to me. The retail crowd mostly would lose. That it wouldn't take long before the dealers would figure out what was going on and would then work against the retail trader and just take their money from them. So usually you can get something in the retail space working for a while, but they're not reflexive enough to understand that the other side is going to figure it out and work against them. And that's the name of the game. There's a bunch of smart people on the other side that says, okay, they're doing this right now. How do we game that? And they will. They'll corral them in, they'll lure them in, and then they'll take their money. Apparently it's institutional trading or larger fund trading going on. So that just raises more questions about what that means, and probably raises the level of risk a little bit in the system, because now it's not a bunch of dispersed traders that are collectively doing the same thing. Now it's more concentrated trades that, if it's going on through a number of institutions, you have what's called a highly correlated trade. Well, when highly correlated trades unwind, everybody runs for the exits, and these are elephants stampeding for the exits, not just a whole bunch of ants that are scattering every which way. It usually breaks things, so that just became more interesting, I think. I recently see that Powell is expecting to raise interest rates until they attain certain rates. Okay, earnings, as you said, will go down and we'll enter a recession. If the Fed do not control inflation, could we see a raise of interest rates like the Volcker period in the 80s, which got to 20%? You never know. From where we're standing right now, I just can't see that, only because they've been informed by history and are, really set on not repeating that history, and that the history that they're pointing to was really a result of the Burns era Fed, where they raised and held, and always and we're always chasing inflation. That this time they're going to get ahead of it no matter what. Period. They're not going to fall into that trap again. So I don't know that you'd get to that level again. No, but here it is. All we can do is take the information we have, and based on where we are right now, try to imagine a situation like that something would happen along the way. I think that would break something if that were the case. Not to say confirmation bias, but I also wrote ES 4000 calls on Friday. They paid off nicely. I closed my 41s today. I closed 30 of them. I closed 130, 128, and 126. I closed 30 of them for 46,000 and change. It was a very good day. I'd be curious to hear your thoughts on rising up the corporate ladder. Obviously, you want to be great at your job as a starting point, but do you have any views on the politics of navigating your career up the corporate ladder? Well, the higher you go, the more political it becomes, right? It just does. So you have to eventually learn how to play that game, but I wouldn't start playing that game. I wouldn't play politics at first. I would observe, and I would be very aware of who has a concentration of power in the organization. It's not always who sometimes the power center is not on the organizational chart. I think advice for anybody in a company, that the best advice I could give is make your boss look good, period. Because if you make your boss look good, your boss is promotable. And your boss is only promotable if they have a replacement. And if you've made your boss look good, your boss is aware. You have to get used to your boss taking credit for your work. That's going to happen. That's going to happen. But I wouldn't nitpick about that. And I would never go over their head. Make your boss look good so they're promotable. That means you're promotable. That's how you move into your boss's position. And just be known as the go-to person. That whenever there's a problem that needs to be solved or something that needs to be done, you're always the one saying, yeah, sure, no problem. And that you get it done. And that may require nights and it may require weekends, but you have to ask yourself, what do you want in life? You want a 40-hour-a-week job? Then don't get a career. A career is a career. A career defines you. A career is something that you extract meaning from. It becomes part of your identity. It is something that you want to do, something you get to do. If your job is something you have to do, well, you're never going to be great at it because you have the wrong view of it right away. And listen, you're not going to love every job you do. It's okay to say, well, look, I have to go to work. Okay, well, then you also recognize that this is not where you're happy and you need to go somewhere else. If you have to go in, then you're not happy there. If 40 hours a week is draining you and you can't wait for the weekend, this is not your career. This is not anything that's going to define you and be part of your identity. So when you enter the career phase, what you're looking for is meaning, right? You want to find meaning in your work. And once you find meaning in your work, it's not work. It's not work anymore. so that you don't really see yourself as having a job. You see yourself as having a calling. But if you can't find meaning in your work, and the only meaning you find is the economic reality of needing a paycheck every 2 weeks, you're going to hit a wall at some point where it's going to be obvious within the organization that that this is not you. It's not part of your identity, that you're here for 40 hours a week and that's all we're really buying from you. We haven't bought your soul. We don't own your soul. And I know these are harsh words, but maybe not own your soul, but we don't see that you're invested in it, that you don't eat, sleep, and breathe this industry. So that would be I think that's my best recommendation, is don't play politics until it's necessary to play it. Let's see, regarding part 1 of February 19 market outlook, section starting around 10. Interesting that for many years before pandemic, core sticky CPI was rising 2 to 2.5, and core flexible stands still around 0, combined to result in around 2%. However, majority of inflation is coming from sticky components. According to the last part of the video, it's labor and energy. Pretty much. Well, higher energy prices will find their way into every price, because GDP is energy intensive. Not as energy intensive as it used to be like 40 years ago, but it is energy intensive. That reflects ongoing improvement in general skill set of the population. Well, you could say that it reflects the increase in the general skill set of the population. But right now, with the participation rate so low, it probably reflects more a shortage of workers. What about energy? Is it really getting steadily higher and higher? The cost per dollar of GDP has been getting lower and lower. So if you look at a dollar of GDP, and you look at energy costs, it's been doing this from about 50s, 60s onwards. It's been dropping. China's much GDP is much more energy intensive than North America is, but they are getting better. But the cost per dollar, in terms of the amount of energy needed, has been dropping over time. So it's not that it's getting more expensive. We could say, well, the price of gasoline per gallon or per liter over time has only gone up. When I started driving, I remember the price of a liter of gas was maybe 24 cents. It's never going to be that again. We see, $1.05 per liter. We think, gas is on sale, $1.05 per liter. What is going to make it, I think, more expensive going forward is you have underinvestment in traditional hydrocarbons, and you have a shift to green energy transition, which requires a whole bunch of capex, a whole bunch of capital investment up front. So it is going to actually raise the cost of energy. So the amount of energy per dollar of GDP, the cost of it is going to go up. So either margins get squeezed, or you will get less for every dollar of GDP. That's inflation. All right, so it'll lead to one of two things: either a shift in the share of income in the economy, and with corporations taking less, or with less service and less product delivered per each dollar of GDP. Two questions. You mentioned that trading volume in 0 days expiration has significantly increased. Do you think it's connected to rising popular Wall Street bets? Well, being that we now have some research showing that the percentage of retail trade is very, very small, I don't think so. While your approach to analysis can no doubt show what fundamental value an asset has, it can't really say how far the price can deviate from it. No, it cannot. Do you think analysis of retail sentiment can somehow help with that? For certain names, I think if you think about the meme stocks, maybe. There is, I do get through my news feed on Interactive Brokers, the top 10 tickers on Wall Street Bets, or the top 5 tickers today on Wall Street Bets, and what they're talking about. Remember you said that you would buy inverse retail traders ETF because most lose money. Most do lose money, yep. Our gain is someone else's loss. In derivatives, you can say it's a zero-sum game. In active management, you can say it's a zero-sum game. So if the market is widely held and you have active managers, for an active manager to beat the market, somebody must lose somewhere else. There is no other way. Because if an active manager buys one extra share of Apple, if everyone's holding the market and one person buys one extra share of Apple, somebody had to sell that share of Apple. So active return is a zero-sum game. Derivatives are all a zero-sum game, but the equity market is not a zero-sum game. It's a wealth creation and destruction tool. Wealth can be created and destroyed. So no, it's not necessarily all a zero-sum game. Some parts of it are zero-sum. Active management is zero-sum. You cannot overweight Apple without somebody underweighting it. You just can't do that. Let's see. XLB has outperformed this year. What are your thoughts? Materials? I don't know that I have any thoughts on that, but am I surprised? No, but I don't know that I have any thoughts on it. EVs, green energy, continuing demand for homes, steady disinflation lead me to think that the materials sector as a whole would see increased demand and margins leading to continued outperformance. Yep, I agree. I agree 100%. You don't need to convince me there. I'm rather than materials, I'm in home builders and miners. Which has got an overlap with materials to some degree, but that doesn't surprise me. I think we're almost done here. In last Q&A, you mentioned you spotted a weakness in the market and shorted a few more contracts. How did you spot that weakness? I don't think I spotted a weakness. What it was the market rallied on one Fed official suggesting that they could see rates going from 5 to 5.25, and they made a really parabolic statement as well, saying there are those that think that we are trying to or that what we're doing is causing a recession, and then it said followed with nothing could be further from the truth. And I thought, nothing? You can't think of anything that could be further from the truth than that statement? Nothing is further from the truth? Come on, man. Like, if you're going to use extreme language, at least be sensitive to what you're saying here. Nothing is further from the truth. The earth is flat. I think that is further from the truth than what you just said. So you lose credibility when you say stuff like, nothing could be further from the truth than will cause a recession. Come on, man. Anyways, the market rallied on the statement of one person forecasting the unknowable future. Well, good enough. I don't think that's a real rally, and it turned out that it wasn't. Interest rates are not coming down, or even go up a little more. How does one profit from adding long duration? Well, the long duration is a recession play, right? When you have a yield curve that's as inverted as it is, and it added more inversion just this week alone, the 3 month to 10 year is back over 100 basis points, and the 2 year to 10 year is now breached 100 basis points. It is the deepest inversion in this cycle. You got to go back to 81. You got to get past 200 basis points to break 81, but you got to go all the way back to there for an inversion. Never, ever, ever have you had these kind of deep inversions and not had a recession. But since you can't forecast when the recession is, duration is one of those things that, chance favors the prepared mind. You got to be prepared, which means, think about it as like, if you don't have a lottery ticket, you can't possibly win, even though the chances of winning a lottery are low. It's the same thing with this duration trade. Is if you don't have duration, you're not going to benefit when rates do drop because of recession. When is a recession? I don't know. Beats me. I don't know. That's the lottery part. I'm certain the lottery is going to happen. I just don't know what day the lottery is on, but it's going to happen, and that's why I have duration. Let's see. What do you think about the market last week? It feels like there's really a support around 200-day moving average. Yeah, it does. And even this week, it didn't feel like it was willing to drop much below that. We will see what the jobs numbers on Friday do and what the CPI next week does. If those come in hot, I cannot see the 200-day moving average holding. I simply can't. When the fundamentals show up, the technicals mean nothing. Barkin's speech this time didn't move markets that much, but 2 weeks ago, IRCC, I don't know what that is. Two Fed chairs suggested 50 basis points. Request to have tutorials on other parts of videos similar to the one you put up on rates. Also more artwork. Artwork. Can you explain what causes the carry to go away on ES? Time. The carry is a function of the interest rate, what it would cost to borrow the underlying and carry it to expiration, such that there is no arbitrage between a futures price and the underlying price. So just time. As time goes by, the carry disappears. That's all it is. And here's the one thing I do know for absolute certain. Time will pass. Don't ask me how I know that. It's just a feeling I have, but time will pass. And because of that, if I have positive carry because I'm short, every day I will earn that carry. It will just happen. What do you think about using standard deviations away from at-the-money prices as a point to decide where to sell negative option spreads? Yeah, you could do that. Delta follows very close to that as well, but you could use standard deviation, and I think you'll find you'll line up with certain deltas. Remember, for your normal distribution, which options pricing is based on normal distribution, one standard deviation covers 68%, right? So you got 32%, 16% in each tail. So if you think of deltas as probabilities, there's your 0.5 delta. This would be your 0.84 delta. This would be your 0.16 delta. So if you're looking at puts and calls, if you're using 16 delta puts and calls, you are one standard deviation away from where the price is centered. But yeah, you can use standard deviation. We already talked about this one. This is a sort of a repeat question. I already replied that I answered it. Just a thought on your confusion, and mind you, I have no idea what the split of assets invested in the market is retail versus institutional. Well, I'm sure institutional investors see what you see. Could it be that prices are held where they are because retail investors have been conditioned by more than a decade of bond yields being close to nil, to a point where they are now blinded by the opportunity they present versus equities? Yeah, there is some anchoring. That is a bias called anchoring and adjustment, where you anchor to a particular price or you anchor to a particular scenario, and then you simply just adjust from your anchor. So I think there is a lot of anchoring in the market, because for how long now? Going back to 2008, 2009, 10, 12, 14 years, we've been conditioned by a Fed that was very concerned about the volatility in the market and the nervousness in the market. Very concerned about it. So you become conditioned to that sort of thing, and you anchor to that, thinking that, well, we're just deviating right now and then we're going to go back. But if you were in the markets long before that happened, you anchored to something different, and that the last 10 to 12 years was the deviation from the anchor, which is to actually have yield in bonds. And Powell, even on confirmation, was of the mindset that the zero line is temporary, and you must move away from the zero line, period. You have to move away from the zero line. It's temporary. So even if rates drop, would they go back to zero? They'd only go back to zero if something presented such a systemic threat to the system that you had no choice but to drop it to zero. Like the great financial crisis, like the pandemic. So if the next recession is just your typical, recession where there's a drop in demand and, like 2000, let's say you have a recession like you had in 2000. Yeah, they probably drop them, but not drop them to zero. Can you go over again? If you want short beta, why not just buy a put instead of shorting ES? Well, if I buy a put, I got to put out money. And I get no carry. I have to overcome the put price. So if, let's say, I buy a put on S&P, on SPY at 400 and I pay 10 bucks, I don't actually make anything until SPY gets under 390. But if I go into the futures and I sell a call, or sorry, I short the futures contract for June, there's about 40 points of carry, which means I'll be shorting at 40.40, which is about 404 on SPY. Basically, so the market over that period of time can go up 40 points and I don't lose anything. But with the put, I lose it all. So that's why I don't want the put. I bought SPY 400 puts 2 months ago, and although they are barely negative, I thought they would have been in the money by now. Well, when you buy the put, you have negative carry, right? Your negative carry is theta. So theta is your time value. That will melt away every single day. Time is against you. When I short ES, I have positive carry associated with the interest rate, which means as every day goes by, I win, you lose. The difference between those, is it just due to the dividend, the positive convexity? No, it's due to the decay of time, and time is based, time is money, right? You bought time, and time is whittling away. I sold time, and time is whittling away. Do you want to be long time or short time? Time is going to pass. I'd rather be short time, right? In your applied series, you say you only buy puts if you expect a short and fast drop in the position. That's the only time to buy puts. Or if you are creating a synthetic short, then you would buy a put. Or if you are creating a short risk reversal. So if it's part of a larger strategy, you would buy the put. Also, buying the put is worth it if you want to create a put spread. Or if you need to manage margin. So let's say that you were short 50 puts. And you in your portfolio, and you had a margin, you had some margin issues. You can go way deep out and you could buy 50 puts. And these things you're only going to pay like 50 cents for. Like you're going to try to get them really, really cheap. And now you have a spread. So the margin requirement, you don't have this level of risk. You have a very defined risk now instead of undefined risk. So your margin requirements would drop, and that's one easy way to come up with margin in your portfolio, is doing something like that. But from a speculative position, I'm not a big fan of buying puts. If I believe the market is going to drop very quickly, let's say that here we are right here. SPY's 400, and I think, no, we're really going to drop. I'll go down to the 380 calls, and I'll sell the 380 calls as opposed to buying the puts. Because if I sell the 380 calls, my break even might be up around 402. I get an extra $2 in there, and if it drops very quickly, great. I can make a full 20 bucks. But if I buy the 400 put, I may pay 10 bucks, which means this has got to drop to 390 just for me to break even, and then I only make money from 390 to 380. Whereas if I sell the call, I can do very well. What else do we have? I have no idea where SPY goes in the short term. I'm simply buying puts with the expectation that SPY will be below 400. What's the trade-off by making a simple bet? I think SPY will be below. Okay, I think I've just explained all of that. Okay, next one here. We're almost done. I think we got 3 or 4 more to go. The partisanship of this congressional testimony hearing is absolutely nauseating. Oh, isn't it? And difficult to ignore. I'd love to get your take on how Jay Powell has handled himself during this Q&A. I think he's done very well not to be drawn into conversations that have nothing to do with monetary policy. Quite a few times he was asked to comment on things, and he just said that's really not our field at all. But you knew that there'd be grandstanding and stupid comments, and the cameras are rolling, and these are politicians. They don't really care about doing the right thing there. They're there for themselves. They're there for the sound bites. They're there to say, I spoke truth to power. I'm not afraid to stand up to the Fed chair. And this is what, that's all just, it's all nonsense and nauseating. And some people, especially today with Congress, you listen to some people talking, but you're just making a speech. There's no question in what you're saying. You're making a speech about how bad the other side is. That's all you're doing, is making a speech at this point in time. You have no question. Like, really, it is nauseating. It's absolutely nauseating to watch this stuff. I think once he reads his prepared remarks, there's really nothing to see. There's nothing to see. It's just a dog and pony show. Actually, I don't even want to call it a dog and pony show because I like dogs. I think I like ponies. You got to call it something else. It's a shit show. There it is. Nobody likes shit. It's a shit show. What would be a good alternative to TLT for a Canadian investor who doesn't want to pay the currency conversion fee? I really don't know anything about the Canadian market. Honestly, I would be hard-pressed to tell you anything about the Canadian market. If you told me pick 5 large-cap stocks on the TSX, I'd pick the banks. And if you said, no, something else, I haven't got a clue. Give me one big tech stock in Canada. I don't know. I don't know. RIM, are they still around? BlackBerry? I imagine they're still around. I mean, I really wouldn't know. It sounds odd, right? How can you live in that country your whole life and not know anything about its market? It's just because I don't trade it. I don't trade anything on the TSX. Other than some REITs. I mean, I have some Canadian REITs because it just makes sense. But other than that, nothing. So I really don't know what a good alternative to TLT would be. Any thoughts on India? There's another one I don't know anything about, is India. I really have confined myself to the U.S. market. It is the biggest game on the planet with huge amounts of opportunity. That to start running around the planet looking for other things, I guess I could, but there's so much opportunity in my backyard. Like, why? Why would I do that? And since I only manage money for me, I stick with what I know. Guidance: how to assess a total short position in the portfolio. Do you compare your net liquidation value to DDB? Let's assume your net liquidation value is 100K and your dollar delta beta is 70K. Can we say we are 70% net short? Well, if you have dollar delta beta 70K, no. Keep in mind let's say you have 100,000 all in stock with a beta of 2. You'd have dollar delta beta of 200,000, right? So it just tells you based on the 100,000 how much you're leaning in or leaning away from beta. Let's say that you have $100,000 in your portfolio and it's all in gold. It'll show you that you have a dollar delta beta of 0. But clearly you've got price risk. You've got gold price risk. So you do have some risk in your portfolio. So it really just tells you based on those things in your portfolio that have a known correlation with the market, or that have some beta, measurable beta, so that if you regress those returns on the market returns, the beta coefficient would be significantly different from 0. There would be some coefficient, some explanatory power to some degree that would be captured in your portfolio. So it doesn't really tell you much other than how sensitive your portfolio is if the market changes. I shouldn't say how sensitive your portfolio is. How sensitive your portfolio is to changes in the market factor that can be measured. That's all. So it's not really a holistic risk measure. It just sort of gives you that. So you can look at value at risk. That's kind of a better one to look at. But if you have a lot of options in your portfolio, value at risk is meaningless because VAR is based on a normal distribution. And your short puts will have typically a negative skew. Now, I got something to say about this negative skew business because that's always brought up a lot. An unmanaged short option portfolio will show this type of distribution because you'll have a whole bunch of small gains and every now and then a very large loss. And the belief is that if you run a short options portfolio, this is the type of distribution you would have, whereas a long distribution, a long portfolio of options would have this, where you'd have a whole bunch of small losses and some large gains. This is simply not true. This is an unmanaged position. First of all, you'd never allow this to happen. You would step in with risk management long before this happened. So you typically end up with something that looks more like this. You can turn it into positive skew, slightly positive skew, which is what I do. So if you look at my portfolio volatility, it is very, very low, very low. But if you look at, put a chart up of how my portfolio changes over time, it does this. Like, it basically does this. And it's almost constant up like that. You can almost draw a straight line while the market's doing this kind of thing. I have very, very low volatility because of this. Because this long tail, that's for an unmanaged position. That is just saying, okay, well, let's take a short options portfolio and let's backtest it. That's backtesting it without any rebalancing. That's just saying, oh, you sold a put on this and you really lost big. Yeah, if you hold it to expiration and you don't do anything and you let the stock just steamroll, you sure. But you're going to step in and rebalance your delta position. You're going to do it. If you're not, then you deserve this tail. So even something like value at risk and expected shortfall really aren't very helpful to me at all. So it's sometimes it's difficult to exactly know how my portfolio is responding, but I can see my portfolio value at any given time. And as the market's moving, if it starts moving too much, then I know that I've got something in my portfolio that's causing me groove. I know I need to add something somewhere. So this is the type of return profile that I look for, this nice, slow, steady increase each and every day. Well, maybe not every day, but week over week, I'm usually higher. Let's see. Is there a metric you watch to guide us we should be watching so net short position does not hurt us? If you have the applied series, I put up a series of videos to show you how to manage each of your positions in terms of when you want to rebalance based on the delta that you have, and if you're holding a stock position that goes wrong on you, how to immediately step in and minimize that from getting worse or even recover the loss. Where do we get high-grade corporate yield rating-wise? You can get it right from Fred. All you have to do in Fred is type in IG, OAS, Fred, and it'll be your first link. And then you could change IG to high yield, then you could change that to AA, you could change that to BBB, you can change that to CCC, and just keep OAS Fred, and whatever it is you want to find, and it'll give you a chart. My girlfriend is mocking me for getting excited about your videos. How do I respond? I think I've already responded, but in the end, she knows where the door is, right? In US Euro trade, US is the base, Euro is the price currency, correct? If you're putting it in that form, US.Euro, yeah, then the first one of the pair, it's a market quote. The first one is the base, the second one is the price. I know CFA shows this order differently. They show it as a fraction. So this would be Euro over US, so that the fraction always is something over 1, right? So if you want to be long US, you buy this pair. Yeah, if you want to be long US, whatever pair you look at in the market, if it's the quote something, ABC dot XYZ, buying it is long ABC, selling it is short ABC. Let's see, yeah. Do you see any issues with the anti-disinflationary practices currently going on in the auto sector? It seems like those practices fly in the face of competitive markets and the idea of why capitalism is beneficial to consumers. Yeah, that's why there are laws against this sort of thing. That if a bunch of auto executives got together in a room and talked about production and prices, that's collusion and that's price fixing. That is highly illegal. But there are things called tacit collusion, where you're working on something called common knowledge. So this was something the airlines came to, and something that Coke and Pepsi came to a long time ago, is that nobody benefits from a price war. I know that, you know that, everybody knows that. So I'm not going to start one. And I know that you're not going to start one, and you know that I know that you know that you're not going to. That's what common knowledge is I know something, you know something, I know that you know something, and you know that I know it, but more importantly, you know that I know that you know. Once you have those conditions, then you have tacit collusion, where it's in our best interest if we all act a certain way. And since we all know it's in our best interest if we act a certain way, and we all know that we all know, then that's what will happen. Well, there's not much you can do with tacit collusion, right? It's this is a game of strategy, and that's part of strategy. And so you'll get disruptors coming in and doing something different. At some point, somebody will do something that's not part of the game. Hopefully, or at least hopefully. Let's see. The left will say these practices are reason for regulation. How would you regulate that? All right. The right will say that we need deregulation to fix it, which is probably, to fix something like that, you want lower barriers to entry. I absolutely think that's the better way to go. The auto industry, especially when it comes to this, due to high barriers to entry, I find it difficult to believe that new entrants will magically show up to enjoy the high margins, driving down prices over time. It used to be high margins for entry, but now that you can get assembly done almost anywhere, you can really just be a design studio. Magna you can design a vehicle, and if you're willing to pay all of the startup costs, you can have Magna just assemble the whole thing for you if you have a market for it, which still has fairly high barriers to entry, but not like it used to have. Listen, they're going to do that for as long as they can until they can't do it anymore, right? That's how what it's going to come down to. It'll be that one company will have a little too much supply that will find its way on the market, and the other ones will follow suit. Because the thing about tacit collusion is we all agree that if somebody oversupplies, it's going to hurt everybody. So no one's going to oversupply. However, if somebody does oversupply, we're all going to get hurt if we also don't oversupply. So usually you need a new entrant who doesn't understand the rules of the game in order to break the rules of the game. Is silver a good investment in 2023? No idea. No idea. I don't like silver. I don't like buying precious metals, because if you point to precious metals, I'll always point to copper. No matter when you say we should buy this, I'll point to something else. There's always something better than gold and silver. I'll always point to copper. Always. So, I don't know. Let's see. And the rest is, that's it. That's it for the week.